It is often said that there are two great certainties in life, death and taxes. And there's a point where these two certainties come together. That merger is called inheritance tax. It used to be called estate duty. But both terms very carefully and cleverly mask and conceal what it really is. It's a tax on dying, a death tax. All of our lives we are taxed relentlessly. Our earnings are taxed. We pay national insurance contributions, another form of tax. We buy a property. We pay stamp duty tax. If we invest wisely and well, and our capital grows, we pay capital gains tax. But for many, the biggest tax bill of all could well be that death tax. I suppose one could almost say the best way to avoid it is not to die, but I'm sorry, I cannot give any guidance in that area. What I would like to do in this brief talk today is to explain the basic elements behind inheritance tax, talk about personal exemptions, show you how the tax is calculated, and then most of all, explain how your financial advisor can help you to pay less inheritance tax and maybe none at all. All comments are based on current legislation, and of course legislation can change over time. The government is currently looking at all aspects of inheritance tax legislation, and changes may come. The big point I want to stress is that inheritance tax can, to a very large extent, be considered a voluntary tax. A voluntary tax. So why would we ever choose to pay it at all? On the one hand, the government says, we're going to take 40% of everything you have accumulated after certain exemptions. But on the other hand, they say, but if you do this and that and the other, you can pay much less tax, or maybe none at all. So why wouldn't any of us do the this, that and the other and pay less or no tax? I think that there are two reasons for this. Firstly, death is not a pleasant subject. It's hardly a dinner table conversation topic. It's rather like wills. We keep putting off writing wills. These are distasteful subjects. We don't like to think of dying. There's a second reason, I believe, and that is most of us, if we know anything at all about inheritance tax planning, we know that we have to make substantial lifetime gifts. We give away big chunks of our capital, and then we have to live 7 years. This indeed is a tool that can be deployed, but it is certainly not the only tool. And our reluctance here lies around the fact that we just may not want to give big sums of capital away. We may feel we have sufficient income and capital for our reasonable lifetime requirements, but the future is uncertain. What if highly expensive long-term care is ever required in the future? We just can't risk giving too much capital away. So let's now have a look at some of the detail here. On death, all of our assets and liabilities are calculated. The value of the estate needs to be determined, so we have a slide which shows you how this is done. First, all assets are totaled. The value of your home or other properties, your motor vehicles, any jewellery, goods and chattels, fixtures and fittings, maybe your jewellery, your fine art collection, and maybe if you're lucky you've got a very good wine cellar as well. Also, any substantial gifts you've made in the previous 7 years and any monies owed to you. So a total asset listing is calculated, from which may be deducted liabilities, any mortgages, perhaps an equity release arrangement, any debts or loans. So we come to a net taxable estate figure. Following that, certain personal exemptions are applied. I will go through these. Each individual has a personal exemption limit of £325,000. I call it personal exemption. It has a fancy name. It's called nil rate band, but I prefer personal exemption. A married couple, it doubles up, 650,000 exemption. If, however, a married couple own a property and are leaving the value of the property to direct descendants, this can include children, adopted children, stepchildren, then an extra level of exemption applies. That figure is £175,000, again per person. So the basic 325 plus 175, £500,000 is doubled to 1 million for a married couple. So let's now have a look at some actual examples of the tax that will be payable. I'm going to base this on a figure, an estate value of £2 million. My reason for that is a slightly different set of rules apply for an estate above 2 million. So here we have on the slide a single person, his or her estate is worth £2 million. We deduct the 325,000 personal exemption, leaving 1.675 million, taxed at 40%, a whopping £670,000 is payable on this person's estate. We turn to a married couple who have no children. Whether they own a property or not is not relevant. Here the single exemption is doubled, so 2 million less 650,000 equals 1.35 million, 40% tax. Their tax bill is £540,000. Now we come to the married couple owning a property, gifting it to children or direct descendants. Here they get the 1 million exemption, so the 2 million estate less exemption, 1 million left over is taxed at 40%, and here the tax bill is still £400,000. Let's imagine, for example, that this couple have 4 children. The net estate is going to be £1.6 million. So each of the 4 children will inherit £400,000. That's the same figure as the taxman gets. It's a bit like saying this couple actually have 5 children. One of them rather unloved and unwanted, but that person gets as much as all of the other children do, £400,000. These are the basic rules and examples. So what can be done? How can your advisor help you to reduce these very substantial sums of money? We have a slide here which gives several different tools that your advisor can deploy. I should state that every situation is different. Some of these might be suitable for one person, but definitely not for another. I start with the annual gift exemption. Everyone is entitled to gift up to £3,000 a year. For a married couple, £6,000. The importance of this is that that gift does not count towards the gift accumulation over the 7-year term. It is therefore completely exempt. However, your advisor can show you how, in some situations, you could gift considerably more than that amount, and it still does not count toward the 7-year accumulation. The next point, if you are making larger gifts over and above the exemption limits, your advisor can show how these can still not be added to the estate on death. Personal pensions. Many of us have a personal pension as opposed to a company pension that dies with us or dies with our spouse. I'm often talking to clients in their 70s and older who still have several £100,000 within their pension fund. What happens to that on death? It goes to the taxman. It counts as part of the estate. Or does it? It actually doesn't have to. If you take proper advice, you can ensure that the value of that pension fund is excluded from the estate and can go directly to whoever you nominate, avoiding inheritance tax. Individual savings accounts. Now, these correctly are marketed as virtually tax-exempt savings vehicles. No basic rate tax, no high rate tax, no capital gains tax. But what about inheritance tax? 40%. So ISAs are not tax-free. Whatever gains you make could be taxed at 40% on death. Your advisor can show you how all of your ISA capital can be excluded and passed directly to those who you choose, not to the taxman. If, despite all planning, there is going to be some inheritance tax due, your advisor can show you how to get a 10% discount on the tax bill. Instead of 40%, the estate can be taxed at 36%. That in some cases can mean a substantial saving. Wills. In its most basic element, a will simply states what you want done, how to dispose of your various assets. However, a will can also be a highly sophisticated, incredibly useful tool for mitigating inheritance tax. Again, specialist advice is required. Your advisor can help here. It is possible, if the inheritance tax is going to have to be paid, to find someone else to pay it for you. It can be done. Your advisor can show how. I've left trusts until last, because trusts can be fairly complex, but they can play a vital role in reducing the future tax bill. There are many different types and forms of trust. Specialist advice is here required. What I have shown in this brief talk is how the tax is calculated. I've covered personal exemptions, and most of all shown you there are many devices and tools that can be deployed to reduce it. Every Helm Godfrey advisor will be able to assist you in paying less tax. He or she can devise a program tailored to your own requirements and within your own comfort zone. It's a long-term plan. Inheritance tax planning is not a one-off activity. It is a process. It is a journey. Start early, you pay less tax. So ladies and gentlemen, talk to your advisor, give more of your accumulated assets to your loved ones and not to the taxman. Thank you for listening.